Hello friends, last week in my video, I advocated that the bulls needed to push a little more harder if the markets were to rally further. And they did. The market internals, the statistical data that we have, and I'll share it with you in the coming few minutes, seems to indicate that risk appetite went up. But still, the markets did not really gain on a week-on-week basis. So, what's the outlook ahead? What will the bulls need to do to push the markets higher and propel prices on a northward journey? Let's dive right in, and on your screen right now is the market roundup window, which tells me that the fall was led by the broader base Nifty-50, whereas the Bank Nifty was a marginal loser. The US dollar index continued to firm up, and that had a negative impact on bullion as well as crude oil prices. Natural gas went up because last week I told you there was a divergence between oil and gas prices, and there you see it happening in the real world. The USD INR, which is the dollar versus the Indian rupee, saw some strength, and the market felt nervous because of that. The Indian 10-year benchmark bond yield fell 2 basis points, which means the bond prices rose higher, and that cushioned the Bank Nifty, which otherwise would have logged bigger declines. The NSE market capitalization lost marginally, and that too after 3 weeks of gains. Nothing untoward there. MWPL continued to rise along routine lines, and the US indices provided headwinds because all three of them logged mild losses. Coming now to our in-house indicator, the MWPL, what you are seeing is that MWPL has shot up to 30.16%. That's the highest in 2 months. So far, what we were noticing was market-wide position limits, which is the extent of exposure traders had utilized as compared to what the regulator allows, was very, very flimsy. Last week, the traders seemed to have expanded their exposure, their footprint in the market. Unfortunately, the market did not support the bulls. So this effort must continue in the northward direction. The coming week is an expiry one. So beyond Monday or Tuesday, I don't think MWPL will rise. But if it crosses the 31.5%, it would basically be a confidence-inspiring move. The second chart is the stock and index futures turnover. Remember, these are 3 concurrent expiries. So this is April, May, and June. Turnover has risen. No surprises there. It was a complete 5-day trading session week, and therefore turnover had to go up as compared to the prior week. The advanced decline ratio. Now, this is a mild concern. What you're seeing is the advanced decline ratio come down for the second week in a row to 0.94 as compared to 1.10 of the prior week, which means for every 100 losers, there were only 94 gainers. This is not really very good news for the bulls. Intraday traders or one Marshmallow traders were showing a lack of buying conviction. This number has to stay above 1. I update the daily chart on my social media accounts, so do connect with me there. Now for the basis. Basis is the premium or discount enjoyed by the future versus cash. Basis continued to fall. No surprises. As expiry looms closer, basis does contract, and as long as the basis remains positive, which means the futures are still at a premium to spot, bulls can cushion the declines to a degree. So as long as futures are above cash, bulls still have a semblance of hope. Now for our exclusive in-house indicator, the impetus, which you've been enjoying and trusting since the last 2 years, has seen a very sharp decline in the Nifty, which bucked the trend last week. Last week, remember, the Nifty gained and the Bank Nifty lost. And I told you this divergence is not good news. It's pointing towards weakness. And here you are, the market logged week-on-week losses. And now both the indices have witnessed negative or falling impetus in unison. That tells you that the upward momentum was very weak. I want the impetus of both indices to rise along with price rise of the indices to tell me that the rally is sustainable. Now for another exclusive in-house indicator, the LWTD, which is over a year old now, and you've trusted it explicitly, and it's not let us down so far. What you are witnessing is that the LWTD has recorded the second consecutive week of losses, and it's now closed below the zero mark. What it tells me is the coming week will witness muted or weak fresh buying support. I'm talking of fresh buying support and not short covering. Both are two different things. Short covering can slow down a decline, but fresh buying is needed to trigger an up move. So the coming week is likely to see very limited fresh buying support coming in. Friends, in-house indicators done. I now come to the bond market, which is very close to my heart because the bond market is the source of all finance or funding for all other asset classes. Now we are, as you can see on the weekly chart on your screen, at 7.18% yield on the Indian 10-year benchmark bond, which is the level seen in September 2022. What you're witnessing is bond yields are now falling, which means there is buying coming in bonds, bond prices are going up, and therefore yields are falling. I shared on my Telegram channel, which is one area where I put all the research, editorials, and my personal opinions more than any other social media platform. I shared with you how the FIIs have lapped up high yielding index worthy bonds worth $2 billion in the current year itself, and more is likely to follow. So, do we say that rates have peaked out in India and big money has bitten off enough meat between their teeth and now rates can start falling again? Well, the weight of evidence is rising, barring one or two small rate hikes which might come. I think rates are now nearing a kind of a resistance area, which the bond yields are indicating. So we can very clearly put laddering on hold. I gave you windows that have opened, opportunity windows that have opened on 1st April. That is the MIS and the SCSS schemes, which limits have been doubled as compared to the previous financial year. I'm assuming that you have utilized these doubled units, doubled limits, and still have some more checks to write. So I shared with you my game plan of what I'm going to do in the sovereign debt market, which is invest in gilt funds. Is it the right time to invest in gilt funds? I think it's a little premature because I need conclusive weight of evidence that yields have started falling and rates at the street level by NBFCs and banks have started coming down. That's when the yields will fall substantially, bond prices will rise, and gilt funds will witness rallies in their NAV, which will give me capital appreciation, and interest distribution will give me return on investment. So early days yet, I promise to keep you updated as and when it happens. Friends, the bond market's done. I now come to the bank Nifty, which basically saw mild declines of 0.03%, as you can see on the daily chart on your screen. It fell on 2 out of 5 trading sessions, but the 3 trading sessions when the bulls managed to dominate the bears, the gains, net gains, day-on-day gains were very feeble and very weak. The price remains above its month-long moving average, which tells me that the short-term bulls are okay as of now. The 41,840 level, which I wanted the bank Nifty to clear, and it has, is still holding as a support. As long as the bulls manage to defend the 41,840 levels, I think the upward momentum might just persist. But In case of declines, the bulls must not let the Bank Nifty close below this mark. Coming to the weekly chart on your screen, the price is comfortably above the 25-week exponential moving average, a 6-month long holding on cost of an average bull. Although the candle is bearish, but it's not really a piercing or engulfing bearish pattern. So far we can say that there has been profit taking at higher levels. Here again, the 41,840 mark remains a critical area to watch out for. Friends, in the week before last, this index was number 2 on our statistical beta list that we maintain in-house of the most volatile counters. Last week, it fell 3 notches to number 5. What it tells you that because the ranges were smaller, intraday volatility compressed. So that's a minor relief because lower volatility is actually easier to handle for an average retail trader. Last week, I advocated a range between 43,575 on the upside and 40,675 on the downside, which held perfectly well. In the coming week, I expect a range between 43,525 and 40,725. Friends, I now come to the Nifty-50, which lost 1.14%. And as you can see on the daily chart on your screen, it fell on 4 out of 5 trading sessions. The falls were rather more pronounced as compared to the Bank Nifty in relative comparison. The price remains above the month-long moving average, but it's still below the 18,115 level, which I want the bulls to overcome to convince me that they are serious about getting back in the driver's seat. Coming to the weekly chart, I see a sign of concern. What you're seeing is the bearish candle is engulfing the previous week's bullish candle. That makes it a bearish engulfing pattern. That means that the bears completely overpowered the bulls and negated all the gains made in the prior week. The price has closed precariously at its 25-week exponential moving average, which is a 6-month long holding on cost of an average bull. So the bulls are back to where they were a fortnight ago. They must try extra hard to take the markets higher, or the gains that they have recorded in the last few trading weeks might just slide a little further. Friends, in the week before last, this index was number 7 and it fell sharply by 12 notches to number 19. That tells you that the Nifty really had very narrow range sessions and intraday volatility fell, which actually is good for an average retail trader because high volatility is not something he or she can manage very well. Last week, I advocated a range between 18,275 on the upside and 17,375 on the downside, which held perfectly well. In the coming week, I expect a range between 18,075 on the upside and 17,200 on the downside. Friends, I now come to the last bit of statistical analysis where we'll basically gauge the risk appetite by the average retail trader by way of his footprint of where he has expanded his traded exposure. We've already seen that MWPL has gone up. We've seen that in the initial part of the video. Now, if the markets continue to rise, this MWPL will be a springboard from where the bulls can launch another attack on the bears. But if the risk appetite shrinks, then LIFO or last in first out method selling will come off, because the recent initiated long positions will be the first to get dumped out of nervousness. Do remember the coming week is an expiry one, so it makes it that much more noteworthy. Now, as you can see on the daily chart on your screen, the sky blue line indicates the stock options turnover as a total percentage of the entire turnover in FNO. It's gone to a period high. So risk appetite in stocks has definitely gone higher. The army or olive green line indicates the turnover contributed by individual stock futures, which is again at a significant multi-week high. So risk appetite there has also gone significantly higher. Index futures turnover have also logged gains, and that tells you that people are writing out bigger checks because trading stock futures and index futures is a lot more expensive when it comes to span margin, etc., as compared to options. So they've definitely shown a bigger risk appetite last week. Whereas appetite shrunk in the safest instrument out there, the index options. Also, the lowest cost where it comes to span margins, the lowest investable amount required to trade is index options, and there traders have basically cut their exposure and gone to higher risk instruments. That tells me that bulls are at least attempting very seriously to push markets higher. Now, unless the thresholds that I told you need to be defended on both the Nifty and the Bank Nifty, bulls might just manage to hold on to their gains. If not, some amount of nervous profit taking can come in. Friends, I now come to the segment where I share my views about what I would do. I would continue to play for theta decay on interest rate sensitives. It's working out well for me. I've been steady about this since the last few months. I don't really bother about what's being said in the public domain where opinions are concerned, because why change a winning formula when it is still yielding results? I would also attempt a theta decay on select cyclical stocks, because here again I expect cyclicals to come off a little bit because of weakening commodity prices. I'm not rushing into gilt funds as yet. The reason I have shared with you in the bond segment. The divergence that I talked about in the last couple of weeks between oil and gas prices might just continue, and it might even sharpen a bit because the coming week is likely to see expiry in gas futures. So volatility is likely to be high. I'm putting laddering on sovereign bond yields on hold for now. It's on in the cold storage for the near term. I would also attempt theta decay in energy in the May month contracts that will open up in the coming week. But I would not go out there and blindly hammer any and every strike on any and every futures contract that comes in my gun sights. I'll be selective because, like I said, volatility is likely to be high due to the expiry. Friends, I now come to the most popular segment of this video for the statistically minded traders, wherein I share 5 names of stocks that have gained the most amount of impetus on Friday, where you take small exposure, wait for large price moves, and 5 stocks which have lost the most amount of impetus on Friday, where you take big exposure, wait for small price moves. These stocks are for scalpers. Remember, the list is valid only for Monday. Tuesday through Friday, you must check my free Telegram channel, wherein I update this data for free. So momentum or impetus gainers list is led by Shree Cements, SRF, Voltas, Ultratech Cement, and Ramco Cement. Impetus losers list is led by IEX, GMR Infra, Dabur, Coromandel Fertilizers, and Cholamandalam Finance. Before I sign off from this video, a reminder to subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put about here. In the comment section, I would love to hear from my online family as to how our work is helping you trade markets better. And hey, help me reach out to fellow like-minded smart traders like yourselves by sharing my work with your friends and family across social media channels. Thank you for your patience and being with me in this video. Till we meet again in my next video, this is Vijay Bhambwani signing off for now. Have a very, very profitable week ahead. Bye-bye.